Hello and welcome to the weekly commodity market update. I'm Brownfield anchor Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. How are you?
I'm doing well. It looks like you've already had a busy morning. You got the sticker on.
Yeah, it is election day here in Missouri. It's primary season. As an economist or as economists, we tend to say that you should only vote if your vote flips or, if the marginal gain to vote is more than the cost to vote. However, here in Columbia, here in Missouri, we had a tied a city council position back last spring. So they're running again today. So I'm one of those. I vote every time. I don't buy into the whole, marginal cost more than marginal revenue. I vote every time. But in Columbia's case, we actually had a scenario where the marginal change, or, the marginal return to voting was higher than the marginal cost. So there's an example of why people should get out and vote. That's my 2 cents for the day. That's my sermon.
Well, there you go. It's a very in-depth analysis of what's going on from our political pundit here, I guess. No, but
It is a big day across the country. There's
it
several
is.
notable races. We've got a heated Senate race here in Missouri. There's an open Senate race in Arizona as well. So big day across the country.
Indeed. So before we talk too much politics here, what are we seeing right now in the markets? What were the updates from last week? I know we came into the week on Monday. We had some pretty big drops. So what are we sitting at today?
Yeah, and we carried those drops over today as well in the overnight trading session to start this Tuesday morning. But let's just recap where we ended up last week in changes. So old crop corn for September up 11 cents to $6.07. New crop corn in December up 9 cents on the week to $6.09. Old crop soybeans, which is now that September contract, is up 66 cents on the week to 14.32. New crop November soybeans up 32 cents to 14.06. Soybean oil up 4.5 cents to 64.1 cents per pound. Soybean meal up $13.30 per short ton. And then old crop wheat up 11 cents to $8 even. So even though we had the big sell-off on Monday, we finished the week over week up across the board.
So what were really the big factors that were leading us, kind of up, but then down at the end of the week there? So what
Yeah,
was
no,
kind
and
of the
it, I
roller
mean, it
coaster
was
there?
a mixed week. We certainly saw, quite a bit of movement in the markets throughout the week and notable to finish up. But let's just go through the highlights real quick and then we can dive into these a little bit deeper. US weekly ethanol production decreased 13,000 barrels per day last week, settling in at just over 1 million barrels per day. Export sales on the week were soft, down for soybeans, sorghum, and wheat week over week, with cancellations outnumbering new soybean sales. Corn sales were up from a low volume the week before. The quarterly economic data last Thursday showed 2 consecutive quarters of negative economic growth following Wednesday's Federal Reserve meeting, where the federal funds rate was increased another 75 basis points. That brings that short-term interest rate up to 2.25 to 2.5. Open interest fell for corn and soybean futures and options positions last week, while slightly increasing for Chicago wheat. Managed money accounts were largely holding put, trying to understand the significance of the upcoming weather market. Still, there were about 4,500 less corn positions in their net long and 156 fewer soybean positions in their net long as well. New U.S. agriculture export inspections were up for the week on corn, soybeans, and grain sorghum, but down for wheat week over week. Mexico was a top 2 destination for all 4 commodities last week. The first cargo load of grain left Ukraine, that rhymes, on Monday. The load of corn leaving the port of Odessa heading for Lebanon is the first since the conflict began 5 months ago. There's roughly 16 more ships ready to embark after being trapped in the port for 5 months. Elsewhere in the world, China's economic data shocked traders on Monday. That's what largely led our sell-off yesterday, showing that the manufacturing sector in China started to contract, housing values continue to fall, and their employment index fell for the 4th straight month. All of this negatively impacts consumer demand. Lean hogs, soybeans, and oil led the commodity sector lower yesterday on that news. And then today, well, related to yesterday, national corn and soybean conditions ratings were each expected to fall by a point yesterday, but instead steady corn ratings and higher soybean ratings helped push prices down overnight. And then spring wheat conditions ratings rose another 2 points to 70% good to excellent. That crop is looking good, 11% higher than last year and 17% above the 5-year average.
So a lot of information on a lot of different fronts there. So I want to start with Ukraine because I feel like that's where every conversation has to still. We got the first shipment of corn out of there, 26,000 tons, I believe that was the amount there. So really, what does this mean initially for the markets? And then, like you said, there's several more ships waiting in the wings. So what's that going to do to impact markets these next several weeks?
Yeah, no, I think we finally got in the last week and a half, we finally got some concrete evidence to really impact the markets. Early in the conflict, the markets were bouncing all over the board. Then for the last 2.5, 3 months, it's largely been stagnant, and news coming out largely being shed off by the market just because nothing was happening. We were getting all these broad statements, but nothing was happening. So the markets got immune to it and weren't reacting. Then we finally got this deal from the UN 2 weeks ago, last month, and that there was going to be grain that was going to come out to help with food relief around the world. The markets were kind of a little bit, optimistic, cautiously optimistic, maybe that this would actually happen. But then as we moved through last week, it became more evident that grain was likely going to move, and we saw the first evidence of that yesterday. So I think in the short run here, probably what we're doing is we're probably taking a little bit off this market. In the short run here, but certainly as we move ahead to our harvest here in the United States, we're probably looking for some increased export competition out of that Black Sea region now that we're actually seeing grain move through. So some potential weakness in this market as we look ahead, but there's still some strong fundamentals that would support higher prices as well.
So how do traders really gauge how much competition that could physically amount to whenever there's still, a large looming threat that, Russia continues to destroy, different ports or to really weaken the infrastructure that Ukraine has to export these products?
Yeah, so there's corn and grain moving to the ports. That grain is getting loaded, and so certainly we've seen tenders, and the markets are starting to reshuffle to that. It's increasing prices within Ukraine finally, and we're seeing some of the price pressure in especially the European Union decrease. So all those things, supply and demand is a function of price. So as we see prices adjust, that's telling traders kind of where grain's moving to. So that's how traders are adjusting to that at the moment.
And then is there any relationship between maybe a deal like this showing a little bit of goodwill and maybe, any relationship to fuel prices? We're seeing those kind of slide down a little bit, that could be sending some maybe positive signals to consumers that prices are going to continue to fall. I don't know what your thoughts are on that front.
Yeah, prices for oil fell along with the broader market yesterday. West Texas Intermediate fell about $4 to close at $92.50 per barrel. The global benchmark for oil, which is that Brent crude, fell almost $4 per barrel as well to close just right at $100. There's two things that I think are really driving this oil market at the time being. It's not really we're going to start seeing large shipments of Russian oil enter into the market like we're seeing grain. That's not a part of this deal. We're seeing a little bit of increased supply around the globe. The U.S. here alone, last week we noticed, or it was reported that 6 new rigs came online to bring us up to just over 6,000 rigs here in the United States. That's a 2.5 year, almost a 2-year high, 2.5 year high back since the beginning of the pandemic. So basically reaching back to our same capacity we were prior to the pandemic. But then the second thing is global pressures, especially in China, that's cutting into this consumer demand and weaker oil picture. So in the short run, a little bit more production and weaker demand globally for oil. In the longer run, we've got some big news coming out of OPEC and OPEC Plus, which involves a few more countries here in the next couple of weeks, as they're expected to announce maybe that they'll increase production capacity again, which would bring more oil back onto the market and decrease price even more. So I think as we look ahead, maybe a little bit of a bearish picture in oil over the next month or so. Certainly, stocks are painting a picture of tightening supplies. But I think as we look ahead, maybe a little bit softer price for oil.
So as more oil does come onto the market, what does that mean for the biofuel sector when maybe looking at both A, more fuel sources to blend into, but B, also maybe more competition to be fighting there?
Yes. So especially in the case of ethanol, which is a complement product. So we blend ethanol with oil. If oil gets cheaper and gas prices get cheaper, we naturally as consumers consume more of it. And if we're consuming more oil, we're also consuming more ethanol. So that's the picture that's presenting itself in the ethanol market. For soybean oil, like biodiesel and renewable diesel and some other oilseed products, they compete more frequently, and they compete at a larger margin. And so as oil prices come down, that's going to weaken the incentive for renewable diesel and biodiesel. Still potentially there, but it certainly weakens that incentive. So kind of offsetting or different positions depending on which commodity you're looking at there. But
well, on the ethanol side, you talked about the ethanol production dropping in the last week or so. Do you see that as maybe kind of dipping back up? We're still in that summer driving season. I know we're just around the corner from State Fair here in Missouri, so maybe some more people on the road still.
Yeah, no. So this is the natural time where ethanol processors take some time off for regularly scheduled maintenance. I really thought we'd see a little bit bigger of a drop this week than what we did, just given those maintenance schedules. Also, natural gas prices have increased, on higher cooling demand by U.S. homeowners here in the United States. That's increased the cost to produce ethanol, reduced that margin over operating costs, which is basically back down to zero. I think I had the calculation I think had a return to operating cost of like 4.5 cents per gallon for ethanol producers. That's significantly less than what we saw back in April and March when we were seeing very high levels of ethanol production. So there's economic incentive for ethanol facilities to slow down. But again, we're at the period where they're paying a little bit higher for corn, having to bid up basis to get what's left out there before harvest. And like I already said, this is usually a prime time to take some maintenance for ethanol facilities. So I would expect over the next couple of weeks some softer ethanol production numbers. That's certainly not saying that the fundamentals for ethanol are not there. It's just certainly saying that this is the time where it makes sense for those facilities to do maintenance work.
So maybe the hardest hitting question of the day, and I'm sure it's on top of everybody's mind right now. At the State Fair, how do we get $2 a day back to $1 a day?
That's a good question. I don't know. I don't know.
Well, I think we just got to swamp supply. Just bring all the supply. Really, really overinflate that, and then you know what? They can't charge you more than $1. There you
go. Yeah, that's right. That's right.
All right. Well, so reports to watch on the week. Welcome to August. I guess I didn't say that earlier, but we have our first ethanol report coming out for the month on Wednesday, export sales on Thursday, and U.S. trade data that's coming out on Friday. So definitely some key reports for traders to keep an eye on. If you'd like to check out our counterparts on the livestock side of things with the weekly livestock market update, that's Megan Grebner for Brownfield and Scott Brown. We're also at the University of Missouri. You can do so at brownfieldagnews.com. I'm Will Robinson on Brownfield.